In this podcast episode, Anatoly Yakovenko, the co-founder of Solana, discusses the transformative impact of cryptocurrency on the traditional financial system and the future of finance. He explores how crypto can reduce friction and costs in financial transactions by replacing trust with cryptographic proof, the challenges in mass adoption, and the political dynamics surrounding stablecoins. Anatoly also shares insights into the intersection of AI and crypto, the evolution of engineering driven by AI, and the potential future trajectory of distributed finance infrastructure. Throughout the episode, he touches on topics like stablecoins, the inefficiencies of traditional finance, decentralized exchanges, the challenges of social engineering in crypto security, and the regulatory environment. Anatoly explains that the financial sector has been the last major bastion largely resistant to software automation due to its inherent requirement for trust. Traditional finance relies heavily on human intermediaries because processes, such as buying a house, involve complex legal work and disclosures that are impossible for an individual to fully comprehend. These intermediaries extract fees, making finance expensive and inefficient. Blockchain and crypto, powered by cryptography with mathematical guarantees, are now enabling a gradual replacement of these intermediaries with software. By automating back-office tasks and transaction processes previously conducted by costly humans, the system becomes cheaper and faster. This shift involves creating a trustless system where verification happens via open-source, mathematically guaranteed protocols rather than relying on people. Yakovenko likens traditional financial fees and frictions to potholes and tolls on roads that everyone pays for, impacting the efficiency and cost for the entire economy. Each intermediary, like brokers or escrow agents, charges a fee, irrespective of the work's actual complexity or cost, functioning effectively as a hidden tax on transactions. These costs compound, reducing economic efficiency. Crypto and blockchain aim to straighten and smooth these roads by virtualizing the transaction process, eliminating unnecessary actors, and bringing down fees. For example, the use of stablecoins, digital tokens backed one-to-one by assets held in regulated bank accounts, allows near-instantaneous peer-to-peer transfers without traditional intermediaries like banks or credit card networks, thereby saving merchants significant fees and speeding access to funds. Stablecoins, which represent digital dollars on blockchains like Solana or Ethereum, have become central to this new financial infrastructure. Their value lies in being fully backed assets that users own directly, making them different from bank deposits that are liabilities of financial institutions. Anatoly discusses how the political landscape influences stablecoin adoption, highlighting generational and ideological divides in the U.S. government. Republicans, often younger and more technologically sympathetic, tend to embrace crypto as a means to empower individuals and decentralize finance, while older Democratic leadership has shown resistance, perhaps due to regulation concerns and their established control over banking regulations. This political tension has led to regulatory uncertainty but has not significantly slowed global adoption, especially outside the U.S., where traditional financial trust systems are less robust. The episode delves into a fundamental challenge with crypto adoption: the mental model and trust required to engage with decentralized financial technology. Unlike traditional banks that provide customer support and fraud protection, crypto places ownership responsibility directly on users. Losing access keys means losing assets permanently, creating a barrier many consumers find daunting. Additionally, people are generally lazy or risk-averse when it comes to changing financial behaviors, even when incentives exist, such as merchants offering a 2% discount for crypto payments, which many still ignore for the convenience of credit cards. Anatoly underscores that most adoption initially will occur where traditional banking infrastructure is weakest, such as in developing countries or regions with unstable currencies and limited trust in banks, where crypto offers a clear advantage. Anatoly criticizes the legacy financial system as an extractive landscape where intermediaries capture outsized profits through regulatory loopholes and monopolistic practices. For instance, banks pay depositors minimal interest on savings while earning significantly more from government securities, the spread benefiting banks but not consumers. Crypto, by contrast, promotes contestable markets, where competition drives down fees and returns benefits directly to users, supported by transparent and auditable open-source protocols. Stable coins grow competitive by offering higher yields to attract deposits, squeezing traditional bank margins and rewarding consumers more fairly. The conversation highlights how crypto infrastructure, especially stable coins and blockchain-based payments, solves real-world problems for global merchants and consumers. Cross-border transactions that traditionally take weeks and incur heavy fees become almost instantaneous and low-cost via blockchain. Anatoly recounts an example where a phone launch received significant stablecoin purchases worldwide at the same cost as credit cards, but without the associated fees or delayed settlements, effectively paying for multiple engineering salaries just through cost savings. These real economic incentives drive ongoing growth in crypto usage beyond the developed financial markets. Addressing the eternal question of Bitcoin as a store of value, Anatoly offers a pragmatic perspective. His view is that Bitcoin does not fit traditional investment valuation models since it lacks cash flows but serves as a decentralized, censorship-resistant asset, a kind of insurance or hedge against systemic collapse or geopolitical instability. His personal rationale for holding Bitcoin is akin to an insurance policy for catastrophic events such as state collapse or hyperinflation, situations where Bitcoin's portability and trustless nature become paramount. Bitcoin's fundamentals lie in its decentralized proof-of-work consensus, extreme redundancy, and mathematical guarantees. Despite being speculative, these properties make it valuable in extreme scenarios, analogous to gold, but with unique decentralized features. The episode explores the parallel trajectories of cryptocurrency and artificial intelligence, both driving revolutionary changes in technology and society. Anatoly is optimistic about AI's transformational potential, especially in accelerating scientific discovery, engineering, and software development. He views AI as a co-pilot for engineers, dramatically speeding up coding, formal verification, proving software correctness, and innovation. Regarding crypto, AI could help solve critical challenges like writing formally verified, bug-free smart contracts to reduce systemic risks and hacks in decentralized finance. While crypto rebuilds finance on trustless, automated rails, AI is fundamentally changing how technology itself is created and deployed. Yakovenko outlines the complex regulatory environment that surrounds the transition from legacy financial infrastructure to crypto-native systems, especially in areas like securities and exchanges. Current regulations stem from a time when intermediaries, brokers, dealers, transfer agents were essential to prevent fraud and maintain trust, but impose inefficiencies today. The challenge is to create frameworks that enable direct, cryptographically verified asset issuance and trading, e.g., tokenized stocks, without reinscribing unnecessary middlemen while still protecting investors. Achieving this requires new market structure reforms to bridge traditional finance and blockchain, creating a legally compliant path for assets to move fully on-chain. One especially technical topic Anatoly discusses is reducing trade latency and improving market efficiency on a global scale. Traditional exchanges like the New York Stock Exchange have physical and regulatory limitations that create unavoidable delays, on the order of tens of milliseconds, between real-world events and market prices, enabling arbitrage and inefficiencies. Solana's vision is to serve as a decentralized global message bus that reduces this latency by allowing transactions to be finalized as near as possible to where the information originates, supporting a fair, contestable market free of central gatekeepers. This approach improves pricing and transparency by encoding more real-world information faster, which could have profound effects on equity and derivatives markets. Anatoly acknowledges that while blockchain technology itself provides cryptographic security guarantees, the human factor remains a significant risk. Social engineering attacks like phishing, impersonation, and scams exploit users' limited understanding or vigilance in securing private keys and interacting with decentralized applications, frequently leading to irreversible losses. Unlike traditional finance, where fraud losses can often be reversed, crypto lacks centralized remediation, raising the importance of improved wallet security, identity verification, and user education. He notes significant investment in improving these usability and security aspects and foresees faster adoption in regions lacking trusted financial infrastructure. The conversation touches on crypto's uneven global adoption trajectory, with faster uptake in markets lacking reliable banking systems and slower growth in the U.S. due to entrenched financial institutions and regulatory inertia. Anatoly reflects on America's unique entrepreneurial culture, immigrant influx, and the importance of maintaining innovation leadership. He sees crypto as a tool returning financial control to individuals, especially relevant given the challenges of inflation, wealth extraction, and political complexity. However, he acknowledges the slow, one funeral at a time process of replacing deeply embedded legacy systems and behavioral patterns, emphasizing the role of education, trust building, and policy evolution. Anatoly shares his experience leveraging AI tools daily to accelerate software development and project design. He compares working with AI to managing talented but inexperienced junior engineers, enabling him to focus on architectural decisions while AI handles tedious coding. He predicts AI-driven engineering will create a burst of innovation, particularly in fields like healthcare, robotics, and scientific research, transforming industries over the next decade. While acknowledging an inevitable AI bubble, he is bullish on long-term productivity gains and novel applications that will reshape technology creation and deployment. The discussion briefly covers the potential threat quantum computing poses to existing cryptographic systems underpinning crypto networks. Anatoly sees quantum resistance as an essential future upgrade for blockchains like Bitcoin and Solana. Although the challenge involves increased signature sizes and bandwidth needs, he advises embracing these changes proactively to ensure the longevity and security of decentralized ledgers. Such transitions reflect ongoing evolution in crypto's cryptographic foundations, informed by emerging technologies without fundamentally undermining protocol goals. An exciting frontier Anatoly works on is applying AI to generate formal verification proofs, mathematical guarantees that software meets certain correctness properties. Formal verification is notoriously difficult and tedious, but crucial to building bug-free, tamper-resistant smart contract platforms that can safely replace traditional finance's complex, error-prone systems. Advances in AI models, such as recent improvements with Claude, open the possibility of practically achievable formal verification for critical crypto protocols and decentralized finance applications, significantly reducing systemic risks and enabling safer mass adoption. Anatoly explores how persistence in digital environments, like NFT culture or virtual economies, e.g., Ultima Online, creates new forms of culture and value in the crypto space. The speculative phenomena around meme coins represent a form of consensual gambling on collective beliefs, similar to Keynesian beauty contests, where value is driven more by social coordination and expectations than fundamental assets. This interplay between culture, technical systems, and economic behavior underlines both challenges and opportunities in crypto's adoption and evolution. The conversation closes with reflections on the difficulty of verifying digital identities and messages in an age rife with impersonation and misinformation. Anatoly argues that fundamental social trust still relies heavily on community-level relationships, the metaphorical block parties, neighbors, and direct interactions that build genuine trust beyond digital signals. While cryptography can verify transaction integrity, the socio-political challenge of whom to trust remains deeply human and complex. He suggests that decentralized systems complement but cannot fully replace the social fabric that underpins stable governance and trust. For those interested in engaging further, Anatoly Yakovenko can be found on Twitter, now X, under the handle NE. He shares technical insights, discussions on crypto, AI, and software engineering topics relevant to Solana and the broader decentralized technology landscape.